Good afternoon, everybody. My name is Russell Munn, and I am one of the financial advisors here at Hermitage Wealth Management. Thank you all for joining us for our Q3 market review. And I have to say, we're pretty excited about this one. We've had our first policy change in over 12 months. So, to help me make heads and tails of exactly what that means, I'm excited to bring in Joey Madigan and Amr Hassan with Janus Henderson Investors.
Thanks, Russell. Appreciate that. My name is Joey Madigan. I work at Janus Henderson, and I am excited today to bring on Amr Hassan, who is an equity specialist here at Janus Henderson, working alongside myself and my partner, Paul Hallisey. Amr is a CFA, and his background is in international economic policy, which is what he studied at Columbia University. So Amr is great at discussing things at a high level and taking it a little bit, from a 30,000-foot view to talk to people like me so that I can understand it. So I'm excited to bring him on. He's got 15 years of financial industry experience. And today he's going to talk a little bit about some themes and trends that we like at Janus Henderson, mainly from an equity standpoint, which is what he covers. And then he will touch a little bit on fixed income and the election, which I know is a hot topic coming up here shortly.
Yeah, absolutely. Well, Joey, thank you very much for introducing Amber. And Amber, I promise we'll get to you here in 1 second. And I know we have a lot to cover. But, to kind of jump right in on the equity market standpoint, obviously we've been in this higher rate environment for an extended period of time. And like I said, we had our first rate cut a week ago, right, which is definitely big news. Now, a lot of things that we've been talking about with clients is diversification, talking about different investment strategies. So, if you could, just talk to us a little bit about what are the thought processes on Janus Henderson when it comes to the equity markets.
Yeah, absolutely. Hi, Russell. Thank you for it's a pleasure to be here with you today. Joey, thank you for that introduction. As he said, I am the equity investment specialist with Janus Henderson, and part of my role is to articulate our views in the markets and where we see opportunities. As you said, we are nearing the end of Q3, and it's been an interesting quarter. Typically, the summer is a quiet part of the year, but it has been other than quiet this last couple months, especially with the volatility that we've seen surrounding that of policy, labor markets, inflation, as well as central bank policy in parts of such as Japan. So July had first signal of a possibility of the next rate cut being on the downside. We saw markets kind of rally there, got to a peak on July 16th. But then labor markets came in a little softer than expected, coupled with that of a surprise Japanese rate hike, led to this little bit of a volatility and correction. Come by Labor Day, a lot of that kind of just uh, uh, disappeared there, and a lot of that correction kind of went back. So if you went away on vacation, it was a non-event for you. But where do we go from here? What do we see in the future? So you're right. We had our first rate cut in a couple years. Last time we've experienced that was during COVID. Expectations leading up to that rate cut was with 25 basis points, but as we approached closer, it became 50-50 coin toss in regards if we get the 25 or the 50. Landed on that 50, not necessarily because of a dire need or a fear of things getting worse, but more of a preemptive insurance cut from the commentary that we've received from the Fed. When we look at what Fed policy has been about the last couple of years, it's really just been driven about one part of their dual mandate. The Fed has a dual mandate where it's about price stability and that of full employment. When we looked at the last 2 years, it was all about inflation and that price stability. And there was a valid reason behind that. So at one point in 2022, we had inflation touch 9%, something that many feared would turn into runaway inflation. Um, and they kind of threw everything at it to really try to tame that inflation. And they didn't care if they broke something in the economy. But with inflation coming down to that 2.6, still a little bit away from their target of 2%, they can take a more balanced approach to managing this dual mandate and now focus more on the labor market. So we did see a little bit of weakness there, and that's kind of what they hinted on led them to have this 50 basis points of cuts. What does that do for the markets, and what does that do in regards to the base case of a soft landing? Well, many people were waiting for the last 2 years on this recession that has not come yet, right? You had 2023 about a 25% return in markets, and right now the S&P 500 back at all-time record highs, and we're up about 21% for the year. To where do we go from here? Well, we do believe that an easing cycle allows for an extension of this business cycle. Um, Interest rates coming down is an easing in financial conditions and will allow for that to happen. Parts of the market that have been neglected in the last couple of years are really where we want to look for opportunities. I believe there's a deck that I sent you, Russ, if you could put that up.
Yep, absolutely. We'll pull it up right now.
Okay, you guys see that? So when we look at the market cycle, where are we from here? If we're entering a soft landing, an easing of interest rates allows for us to see opportunities in equities as well as the fixed income bond markets. Where I said that we kind of had this non-event happen, so we had this, correction 8-9%. Coming out of that, the leadership in the markets actually changed. If you look under the hood of the S&P 500, yes, it was all about the Mag 7, but if you looked at the last month and a half, the Mag 7 has actually lagged and is still down 5 to 6%, whereas the market is actually at an all-time high because we're seeing leadership change and a rotation into parts of the market that have been neglected, parts of the market where valuations have been underappreciated, as well as the opportunities for earnings growth to be there. You see parts such as real estate and utilities that are up over 10% in this time period that have really been ignored for the past couple of years. This is a part of the market that also tends to be more interest rate sensitive, and is a reason why you're seeing this rotation into these areas with rates coming down. When we look at these rate cuts, we do expect for additional tailwinds to appreciate from this, and it is something that we want to position for accordingly. But again, what we saw maybe for the last decade and a half or right after the great financial crisis, we don't believe is a scenario that we'll see going forward. We had this zero interest rate policy that allowed for basically and almost everything rally at one point in the last 15 years. We do believe that it's going to take a more selective approach to your investments to make sure that you find those those companies with the fundamentals that have the quality evaluations of high credit, as well as earnings growth, as well as cash flows. If we can go to the next slide, please. So for the last 2 years, the story has been all about the Mag 7. It's been the beneficiary of the story of AI, as well as somewhat of a defensive trade of uncertainty. We've had this tightening of over 500 basis points over the last 2 years. So many people kind of had this idea that, well, I don't know what's going to happen in the short term, but whatever happens, Mag 7 is going to make it out the other end. So you had this Mag 7, these large tech companies become this defensive trade, but at the same time, the momentum of AI took over, and it's also been this trade that has allowed for these exuberant returns for the last 2 years. And there's a reason for that. So when we look at interest rates and we look at the impact that they had on larger companies, pretty much was insignificant compared to that of small companies, right? So a company like Microsoft last year for 2023, rates were up 5%, but their interest rate expense was actually down for the year from the previous year. And why is that? So they were able to secure the long-term debt during the lows during COVID. They were locked in these long-term debt accessing the market, and now they were making interest income on their cash balances. So their interest expense actually went down. For smaller companies that tend to be a little bit more dependent on floating rates, wasn't the same case. So there was some valid points to of these Mag 7 becoming this defensive trade. But the only problem with that is people are kind of waking up to what many have never experienced before with concentration risk. So you now have the Mag 7, as it has been this crowded trade for a couple of years now. Weighting wise, it's about over 30% of the S&P 500. If you look at the Russell 1000, it's about 50% of that. So the biggest part of investing in a an index is the benefit of diversification. So you lose a lot of that with that concentration. And then with that being said, you start acquiring a new type of risk, and that's the concentration risk, as we've seen now, the Mag 7 actually becoming the lagging part of the S&P 500. When we look at opportunities, we do believe that AI is a real story. It could be that of a productivity growth that we experienced in the 90s with the internet, but it may be time to trim some of that position to really capitalize on other parts of the market that we feel have been underappreciated. I believe there's another slide after this. So one of the parts of the market that we really think, or we find very attractive, is to go down and cap into that small mid cap space. Small cap companies tend to rely heavily on floating rate bank loans, unlike large cap companies. So they tend to be a lot more sensitive to interest rate hikes as well as cuts. You saw this stop and go in the Russell 2000 as the idea of an easing cycle started to progress. We saw a little bit of that action last week, but with uncertainty of the election, as well as just the somewhat of hawkish comments that followed the central bank decision, it did kind of stall out there a bit. But we do think that it has an attractive opportunity there. And when we go down in cap, we want to make sure that we stay with the same type of factors that we look for in large cap companies. So we're looking for quality companies with cash flows and those able to sustain a different type of interest environment than that we saw 15 years ago. We look at the small cap market cap in general. Right now, it's a total part of the market's about 4%, where historically it's closer to 7.5, 8%. At a Russell 2000 with a total market cap at almost $3 trillion, you have some Mag 7 companies that are larger than that. So this is a part of the market that has been overlooked, and we do think that there is great opportunity if you position accordingly when going down in cap. It is something that we also recommend to go active. Why is that? Well, Russell 2000 currently has about 40% of that of the Russell 2000 are companies that are unprofitable, and what a lot of economists call zombie companies. And what do I mean by that? Well, they're companies that were only able to survive during a low interest rate environment. So Russell, me and you can go. So with zero interest rate policy, me and you can go into business tomorrow. We can try something. It doesn't work out. It's fine. Credit is easy, and low rates allows us to try again. Well, if rates kind of, if we do come down and expectations are for rates to kind of stabilize around 3.5%, well, those mistakes become costly, and maybe some of these businesses that are unprofitable are no longer able to sustain business activities. So that's why I believe the Russell 2000 in 18 to 24 months from now is going to look a lot different than it is now. So because of that, we want to take an active approach to make sure that we're in quality companies with the cash flows to be able to sustain their business activities and be able to flourish and in this type of environment. I guess I have another slide onto another part of the
And
market.
Amber, sorry to interrupt you, but just you talked a little bit about why we like small caps and just their long-term PE average and their valuations versus large caps. Can you just talk about mid caps and why we kind of think that that's the sweet spot of equities as well?
Yeah, absolutely. So mid cap companies tend to be companies that are more mature business or more mature businesses with experienced management able to kind of navigate better this type of environment. They've kind of escaped their velocity from that small cap company with proven business models and have a little bit of a less restrictive ability to be able to receive those bank loans and be able to navigate this type of interest environment. Also, which I'll get to in my next slide, deglobalization is a beneficiary to to mid-cap companies. Mid-cap companies tend to be more domestic, shorter supply chains. With that kind of reshoring, offshore, friendshoring type of policy being passed in the last couple of years, we do believe that they are well positioned to capitalize that on well. So you have fiscal policy that supports it, as well as the fundamentals of businesses able to sustain business activities in a higher interest rate environment. So that's kind of why we look at mid cap being that sweet spot of the market. And also the upside on mid cap is a lot higher than that of a large cap company, just from a market cap potential.
And with that thought process there, Amber, of course, you've talked a lot about domestically, right, inside the
Mhm.
United States and what's happening there. But what about outside the United States, right? You use this term deglobalization. So, outside of the United States, what do you think are opportunities that may be present?
Yeah, absolutely. Funny you say that. If you go to my next slide, opportunities in international equities. So when we look at international equities, um, it kind of ties back to the story of concentration risk and diversification. Now, you don't want to look at international equities with this monolithic asset class view. There's quite big differences between that of developed Europe as well as Asia or emerging markets, but we are going to look at opportunities that complement your US portfolio. We're going to look at companies that might have that advantage that we don't have here in the US, whether it comes from a brand recognition or intellectual IP of that nature. And if you look at international for pretty much for 20 years, it's anytime someone's mentioned international, they're either talking about vacation or a museum. But we do think that the valuations have come down to the point where we think that there's attractive opportunities if you take an approach looking for those companies outside the US with strong fundamentals. Typically, international equities or developed Europe in general, like an EFA index, trades about 20% discount to that of the US. It's currently trading at about 35% discount. So we do think that there is an attractive entry point there. But again, it's not something that we believe where you just take in a passive type of strategy where you just buy an EFA index and call it a day. Do I think the US still outperforms? In general, yes. Do I think that I can get you 40 to 50 the best names outside the US to complement your core holding? Absolutely. Examples of that are ASML and Taiwan Semiconductors. Without ASML and without TSM, there is no Mag 7. Simple as that. NVIDIA designs the chips. Taiwan Semiconductors makes the chips using ASM lithography machines. ASML, many will say, was probably has the largest moat of any company in the tech sector. At 150 million a ticket, it's pretty defensible there. So without these type of innovations outside the US, we're not able to produce or push for that of the NVIDIA or the Mag 7. Everybody has heard about Ozempic at this point. When we look at Novo Nordisk, the largest company in Europe, finding these opportunities complements your core holdings and allow you to have that type of diversification that many people seek when building their portfolio for the long term. So this is how we look at international, and this is how we look at small cap. It's about finding opportunities regardless of where they are. The US does not have a monopoly on great businesses. There are opportunities elsewhere. With deglobalization, we're going to see a lot of that currently. For the longest, it was with also the idea of interest rates being where they are. It's also going to be the same case. For the longest, it was ideas coming or entrepreneurs coming to the U.S. and be able to establish their startups and whatnot. We believe that it's going to be home countries supporting their own industries going forward as we have this deglobalization push, as we see a dispersion in policy across different parts of the world. We want to be able to take advantage of this and not have a home bias as many of us do. Currently, I believe the typical investor only has about a 20% allocation to international, if that. So it is something that we definitely want our investors to look at and definitely have an active approach when trying to look for opportunities outside the US. If you can turn to my next slide, please. So when we think about what we saw in the last couple of years, it's really been a story of innovation. Innovation is always going to be the leader. When you invest in and growth companies, it's a bet on the future. It's a bet on innovation. Everything was about AI and the story of the Mag 7. But why is that important? Why? I mean, many people talk about AI. What exactly is AI? Why is it so important? It kind of ties back to deglobalization. So deglobalization, if I'm friendshoring or onshoring of that nature. So Russ, I'll use TSM for an example, right? So Taiwan Semiconductors is building a manufacturing plant in Arizona. Well, the chips coming out of those plant coming out in Arizona due to higher labor costs and whatnot are about 30% more expensive than that are designed or created in Taiwan. Well, so the onshoring and friendshoring is actually structurally inflationary. How do you offset that? Well, maybe AI is a story. If I can boost productivity growth, then I can offset some of those costs of structural inflation that are coming to fruition due to deglobalization. So that's the biggest impact and why there's been this chase for AI. The idea is that AI is going to allow for productivity growth, which will allow for me to cut costs, which will allow me to increase my margins and become more competitive. Russell, if me and you are in the same business and I adopt AI and I'm now able to increase my margins, able to give better competitive pricing, I'm now able to take market share. If you don't adapt, maybe you don't make it. So that's a lot of why you see this gold rush towards AI and NVIDIA and the hardware or the hardware needed to facilitate the use of AI. So there's a lot of it now we're focusing on the businesses that are using this in application. When we think about that, we think about healthcare. Healthcare is a part of the market that has pretty much been in a bear market for the last 3 years. Um, it had this big burst during COVID, and then you had this COVID hangover once that kind of was in the rearview mirror. A lot of that was, bigger names like such as Pfizer with revenues down 50% year over year last year and whatnot, which really had a downward pressure on the sector in general. But we think that with the application of AI in parts of healthcare, it's going to allow us to discover new medications as well as allow for us to speed up processes. Genome sequencing, for example, is something that took weeks to accomplish. With that, using an AI program, we've seen companies do that in a matter of hours. They're able to not only discover, but they're able to fail faster when it comes to testing. And that's something that will decrease costs instead of having this longer time frame in regards to R&D. Why we think that healthcare is a part of the market that we should also consider when we think about innovation. The market loves stories. Last year was about AI. This year it's about Ozempic, and it's about Manjaro. It's about health benefits, and people are becoming more conscious of this. We have an aging population where by 2050, a third will be over the age of 65. We have a growing global middle class. Well, when people have a little bit more money in their pocket, they tend to care more about their health. So that's why we believe that a growing addressable market is definitely something that will allow us to be beneficiaries of the healthcare sector in general. And that's kind of how we look at it when it comes to investing in areas of innovation such as that of healthcare and technology.
Great. Well, I'll tell you, Amber, that was really interesting stuff. And I do think it couples on the thought processes that we've been talking about, right? Maybe this thought process of the Mag 7 and big tech, maybe not being the way forward, right? And maybe
Yeah.
something new is on the way. So I appreciate all that information there. And you keep talking about this business. We'll have to chat about that afterwards, okay? But maybe switching from something that maybe affecting people on a more day-to-day basis, right? You've talked a lot
Sure.
about the equity markets, been talking a lot about the stock markets, but to your point, I mean, you said it's at all-time highs, right? So people are feeling comfortable with maybe what the market's doing. So how about the thought process on this upcoming election, right? I mean, I would be remiss if I didn't at least talk to you about that and ask you about that because it's by far the number one question that we're getting.
Yeah, absolutely. It is something that comes around every 4 years, and it's actually on the minds of many investors this year. Um, if we go to the next slide, I actually have a survey. So at Janus Henderson, we do a yearly survey where we ask investors in regards to what are their concerns when it comes to their investments. Um, the number one concern was the U.S. presidential election. What does that mean? What does that do for us, and where do we go from here? Well, it's fine to be partisan when it comes to your political views, but based on the charts that I'm showing you here, it really doesn't matter in the long-term view when it looks at it. In all years, we're at 12% during a presidential election. Market does about 10%. Yes, there is a little bit of a dispersion when it comes to whether we have a divided government or a unified government, but not enough for you to make asset allocation changes to your long-term views. Many have to realize or remember that a presidency is 4 years, at most 8 years. A sound financial plan will be that of 10 to 20 or even 40 years. So we need to be able to ignore some of the noise that we see during a presidential election and be able to stick to our long-term plans. Leading up to a presidential election, we will have more volatility. Why is that? Well, we have uncertainty, and markets don't like uncertainty. If we, as we have a clearer winner towards it, we imagine that we'll have less uncertainty. The problem is at this point where it's about a coin toss of what direction we're going here, whether it's President Trump or VP Kamala Harris. The one plus of having both of these candidates is we know what a Trump presidency was, and we're pretty familiar with Kamala Harris probably will offer, being that she was the VP in the last presidency. So that's a plus. And when we look at the two, for the most part, it's whether it's going to be taxes or whether it's going to be tariffs. We don't see any changes or in the outlays of in fiscal policy. For many people, think that's political suicide for you to kind of walk back some of the social benefits that are already out there. But we want to ignore some of the noise that we see leading up the election, because we are going to experience some volatility. But as we do get hopefully we get a clean win and not something that drags on where we have to, count votes and whatnot. But it's something that, as the uncertainty of the next president and as his policy begins, or his or her policy begins to shape, we will see this volatility decrease. So it is going to be a little bit of volatility, a choppiness for probably the remainder of the year until we get past this, and then we have some clarity on the other end of it. But it is something, as you can see, that in the long run, it's really just short-term volatility. But it is something that if you stick with your plan, we'll be all right. But with the uncertainty comes opportunity. So positioning accordingly does allow for great opportunities in the long run.
Awesome. Well, very good, Amber. I appreciate that sentiment. And I appreciate that information there. Now, we did have a few questions come in while you were going through that presentation, and I know you weren't necessarily had that prepared on the deck, but the one thing that we're getting a lot of questions about is on the fixed income markets, right? So again,
Uh,
you've talked a lot about the equity side to the market, but again, with this rate cut, what are kind of thought processes when it comes to the fixed income market or maybe the bond markets? Again, just kind of talking with this diversification type of conversation.
yeah, absolutely. So Fed cuts dictate the short term, right? So they dictate the short part of the curve, but eventually that trickles into the longer parts of the curve. With rate cuts, it is something that we'll see many people start going into more long duration exposure when it comes to the bond markets. It's funny because people will say the same thing about equities, because areas such as tech or healthcare can also be viewed as long duration because they're dependent on future cash flows way out in advance. So you will see this pivot into long duration or longer duration. Many people are trying to play or trying to follow where the money goes when it comes to money markets, right? So uh, first instance or for biggest impact of a Fed cut will be first to on the shorter side, which will be money markets. Maybe 50 basis points isn't the number where people are kind of still parked in the money market fund, but maybe if we do get another 50 basis points, then people start looking for that more long duration trade. You have to remember that historical average of money market was about $3 trillion. So from 2021 or 2020 to 2023, that number went up to over 6 trillion. We're talking about it doubled in 3 years. Does all that money come back? Maybe not, but do we get some. Do we get half of it? 1.5 trillion? Yeah. Well, this cash has to find a home, especially if the markets start performing as they did the last 2 years into this easing cycle. So we believe that this is going to be something where that investors start to extend out to longer duration type of investments on the fixed income side as well as the equities to capitalize on this easing cycle as we have this appreciation in that bonds.
Awesome. Well, I appreciate that because it is a good talking point, right? I mean, we've been telling clients, for an extended period of time, right, that 4% or 5% rate of return in the high yield savings accounts, right? I mean, it's great, but again, at the end of the day, right, eventually it has to flow into something else. Well, wonderful. Well, I appreciate it, Joey. Amber, I appreciate the time, the insight. Amber, again, very, very insightful information that you provided for us, for our clients, and we greatly appreciate it.
Appreciate you having me here. This has been fun, and if there's anything we can ever do to assist further, please reach out to Joey or Paul.
Thanks,
Wonderful.
Russell. Appreciate it.
Absolutely. Well, in closing, everybody, we want to thank you all for tuning in this afternoon. Again, we host these every quarter, so we're looking forward to, maybe a talking point after we get through this presidential election that Amber had talked about. But until then, if anybody has any questions, concerns, thoughts, or just wants to talk, that's exactly what we're here for. Thanks, everybody.